Welcome to Renewable Energy Investments. Today, we're taking a look at one of Chamath's least known SPAC investments, Renew Power, ticker symbol RMGB. This stock has been on my radar since the SPAC deal was announced, as it is a pure-play renewable energy generation company. But only recently has it become interesting enough for me to make a video about it. In this video, we'll cover the potential of Renew Power's business, as well as some key risks, and then, towards the end of the video, I'll share how I'm considering playing this one. But as always, keep in mind I'm not an investment advisor and I don't give any investment advice. Okay, so Renew Power is a pretty simple company to understand at a high level. In a nutshell, it is India's premier and largest renewable energy company. Think of it as the Brookfield Renewable Energy Corp or the NextEra Energy Partners of India. The company invests in utility-scale solar and wind renewable energy generation assets, large batteries to store this energy, land on which the assets sit, and even software to analyze data and optimize and manage the energy systems. Okay, so let me highlight a few items that I really like about Renew Power's business model. First and foremost, Renew Power is India's largest renewable energy company, and is actually one of the largest in the world. Being the biggest player in India gives it a few key advantages. Renew Power is a reputable and reliable company to do business with in India. Essentially, through its size, it develops a brand. It already has key relationships and a history of doing business with India's governmental entities, which award it contracts for renewable energy. Renew Power's size gives it purchasing power. It is able to acquire mass amounts of solar panels and wind turbines at a good price due to economies of scale. Plus, the size of Renew Power's asset base and revenues gives it an advantage when it needs to raise capital. Renew should be able to get loans with better interest rates and better terms than smaller, less established companies. I also really like the fact that India, as a country, has enormous potential for electrification-driven, long-term growth. This is because India is a developing country with an enormous population and has a government that seems to be embracing renewable energy. We all know India has a gigantic population of almost 1.5 billion people and rising. In fact, they may soon overtake China as the most populous country. Here's one of my favorite graphs from the investor presentation deck. India's per capita electricity consumption is tiny compared to less populous and more developed countries like the United States, Japan, Germany, and China. Let's just say, as India becomes more and more developed, you can expect there will be an oversized growth in demand for electricity in India. But the thing that may be the most exciting to me is that the Indian government appears to be well aware of the gigantic opportunity that is renewable energy. I suspect this is why India has recently been courting Tesla to open up shop in India. India is targeting a clean, but more importantly, an extremely profitable and efficient future made up of cheap, clean energy. All this to say that renewable energy is expected to dominate the future of electricity supply in India. And ultimately, this is expected to result in Renew Power experiencing massive growth over the next decade. It is expected to almost double its renewable energy generation by 2023, and then almost double again by 2025, with a 33.9% installed capacity CAGR. Meanwhile, Renew's revenues are expected to grow at a 29.4% CAGR, and its EBITDA at a 30.7% CAGR through 2025. Finally, I also want to highlight what is probably the most flashy part of Renew Power's business. In June 2020, Renew acquired a company called Climate Connect, which is an artificial intelligence, digital analytics, and software development company. When you grow as large as Renew and control multiple gigawatt hours of renewable energy capacity and storage, developing software to reduce costs and optimize output can be a big deal for boosting margins. This could give Renew a powerful advantage over smaller companies with less assets, resources, and data. Let's take a closer look. According to Climate Connect's website, Climate Connect provides these three services: forecasting, real-time, intraday, day-ahead, and term-ahead forecasts, using AI algorithms powered by millions of data points from transmission and distribution networks, generation, and weather models. Energy market modeling, forecasting of prices and bid volumes across markets worldwide, with horizons stretching from the instantaneous imbalance markets through to long-term econometric power price trends. Algorithmic scheduling and trading, AI-enhanced scheduling and trading software, built to increase the speed and reliability of energy market decision-making as the necessity of autonomous evaluation accelerates. Let's just say Renew Power checks the software box. Okay, so with all of the positives out of the way, let's touch on a few of my potential concerns. First of all, the company is in India. Anytime I invest in a company that is primarily in a foreign country, I have to discount the price I'm willing to pay based on what I consider to be a foreign country risk. I simply don't live there, so I am not close to the company and cannot do any of the on-the-ground type of research, where I would try the company's products and services for myself. Plus, foreign companies have to navigate a whole slew of foreign laws, regulations, politicians, etc., that I'm just not familiar with and do not have the time to research. Finally, let's be real. India is simply a riskier place to start a business than the United States. So for all these reasons, I have to discount the price I would be willing to pay for a foreign company versus if that same company were a US company. Second, although Renew is the premier and largest renewable energy company in India, it is still not the largest or the most premier renewable energy company in the world. Some other companies with very similar business models, like NextEra in Brookfield, are much larger, have much more assets backing them, and thus enjoy better financing options and better purchasing power. Plus, these other companies are even more attractive because they pay dividends. So again, all things being equal, I would have to discount the price I'm willing to pay for Renew Power versus some of these other companies. Third, and probably the biggest looming risk, is the risk of what inflation could potentially do to Renew Power's valuation. We have all seen what happens to growth stocks as fears of inflation in the market rises. Their valuations can fall, and fall fast. And Renew Power is a growth stock with no exception. In fact, the nature of Renew Power's business, which involves upfront investments in return for a predictable generation of future cash flows, makes it especially vulnerable to this risk. Essentially, as interest rates rise, analysts will change the discount rate they use in discounting future cash flows of a growth stock to today's dollars. If interest rates rise faster than Renew can grow, Renew's stock price could take a substantial hit. Additionally, rising interest rates would increase Renew Power's costs of financing new projects, which could result in less attractive margins. Okay, so what's my strategy? As a long-term investor, I find Renew to be a very interesting company. The potential is definitely there for outsized growth this decade. However, risks are certainly there as well. With that said, I want to put some capital to work to support the renewable energy cause, so I think I'm willing to take on some risk here. But I don't plan on risking a large amount of capital at the same time. I'm approaching this one with two thoughts. First, I'm not overly anxious to get in on this investment right away. I anticipate the story of Renew stock will be a marathon, not a sprint. It will take years for the growth story to play out, and it's not like Renew is going to invent some game-changing technology in the meantime that I need to front-run. So I am happy to patiently wait for the right price. Anything at or below the $10 SPAC net asset value price might entice me to nibble on some shares. But ideally, I'm waiting for fears of inflation or actual inflation to push this thing down even further, resulting in an even more compelling entry point. Second, the warrants for this stock look like a pretty appealing way for me to play it. If I can control 5 to 10 times as many shares by buying warrants than stock, I can build out a decent little warrant position with relatively little capital at risk. If the warrants fluctuate up or down over the course of a few months or a year or so, I'm not too bothered, because I intend on holding them for the long term. If they expire worthless, it's not the end of the world. They are cheap and shooters shoot. To me, the warrants look like an appealing, low-cost way to get a leveraged exposure to the potential upside of Renew. And over a long enough period of time, there is a good chance the bull story can play out. Let me know what you guys think about Renew Power in that comment section below. How do you see this stock playing out over the next few years? Did I miss anything in my analysis of the bull potential or the risks? As always, thanks so much for watching and have a fantastic day.